Welcome everyone to a new episode of Finance in Focus. We're the podcast team from the Asadi Student Finance Society, and we're very excited to bring to you in-depth insights on the latest economic and market developments. I'm Maria Tsaturan, and today with me we have our fantastic team of members.
Good morning, I'm Noor Bishuti, and I will cover the most recent global and macroeconomic perspectives. I will also focus on how commodity prices are doing and influenced by inflation and supply chain disruptions.
Hello, my name is Gasper and I'll walk you through market performance, summarizing the key movements in global indices. I will also dive into equity research, analyzing a top performing company, discussing its recent performance, financial results, and future outlook.
And I am Tudor, and I lead our Insight Spotlight discussion exploring a major financial trend in depth. I will also provide the week ahead, offering insights into the upcoming economic data releases and other key events that could shape the markets.
We've got a very packed agenda, so let's dive right in. Now, to kick things off, let's first invite our expert in macroeconomic events, Noor, to the table. Noor, tell us, what has been happening in the global economy recently?
Sure, Maria. So, I'm Canadian, and Doug Ford, the Ontarian Premier, retracted his threats on Tuesday just hours after telling U.S. networks that he was ready to cut off all electricity exports unless U.S. President Donald Trump dropped his threat to impose these further tariffs on Canadian imports. Donald Trump has halted a plan to double U.S. tariffs on Canadian steel and metal imports to 50% just hours after first threatening them. Tariffs of 25% still went ahead and took effect on Wednesday. The move by the president comes after the Canadian province of Ontario suspended new charges of 25% on electricity that it sends to some northern states in the U.S., such as Minnesota, hours after Trump threatened to sharply increase his tariffs on the country. Plans have been set for a meeting to take place in Washington in attempts to try to resolve the ongoing trade war.
Looks like some high stakes back and forth between Ford and Trump. Glad to see that tariff hike was at least partially walked back, but 25% is still a bit hit. So, what's the reaction of the EU to the current political situation?
Alright, well, countries have begun stepping away from their dependency on the USA. For example, Sweden stepped up their military spending and have developed autonomous sort of capabilities, including a new rocket base. Major trade partners swiftly hit back at President Donald Trump's increased tariffs on aluminum and steel imports, imposing stiff new taxes on U.S. goods, including products from textiles and water heaters to beef and bourbon. These new tariffs will cost companies billions of dollars and further escalate the uncertainty in two of the world's major trade partnerships. So now the EU duties aim for pressure points in the US while minimizing additional damage done to Europe in general.
Oh wow, that is quite interesting. And following recent diplomatic engagement with the US official, how has the Ukraine responded with the ongoing conflict with Russia? And what broader geopolitical measures are being considered, for example, in Europe?
Ukraine is ready for a 30-day ceasefire with Russia following high-stake talks with the United States officials. However, Russia launched air attacks on Kiev and Kharkiv shortly after Ukraine's declaration, leading to an air raid alert across multiple regions. Global leaders continue to monitor the situation closely, emphasizing the security guarantees for Ukraine. The European Commission President Ursula von der Leyen has proposed the Rearm Europe initiative as well, aiming to mobilize up to 800 billion euros to enhance the European Union's defense capabilities. This plan seeks to reduce reliance on external allies, including the US, and address geopolitical threats, notably the ongoing conflict in Ukraine.
Okay, and we spent quite a bit of time discussing global politics, so let's now turn our attention more to the macroeconomic indicators. Noor, what is the current outlook on the currencies, interest rate, or, for example, inflation worldwide?
The Bank of Canada cuts the interest rate to 2.75% as the country faces a new crisis from the tariffs. The U.S. annual inflation rate in February remains relatively stable at around 2.8%. And with regards to the currencies, the US dollar is still shaken due to the trade wars. The Canadian dollar stayed resilient due to the retaliatory measures taken by the government. Both the euro and the British pound have benefited from the US dollar's weaknesses as they continue to be strengthened. And as of today, gold is near $2,934 per ounce, silver 33.23, and platinum 985, all showing moderate gains. Gold is rising due to the economic uncertainty, silver is outperforming gold lately, and platinum is nearing $1,000 due to industrial demand.
That is a really interesting breakdown. Thank you, Noor. As we have seen, the trade tension between the US and Canada and the EU underscores the growing shift towards economic and geopolitical self-resilience, while this uncertainty is also reflected in the currency and commodity market movements. Alright, so now let's hand it over to Gasper, our expert on global market trends and equity analysis, to break down the latest market actions and top equity research finding.
I'm delighted to guide you through the latest market movements. This week has been marked by significant volatility across global indices, with shifting investor sentiment influencing various sectors. A notable performer amidst this turbulence is Supermicro Computer, Inc., commonly known as Supermicro.
Wow, looks like we have a lot on our plate. So shall we dive into the US markets?
The S&P 500 experienced a decline of 3.74% this week, closing at 5,522. This downturn is primarily attributed to diminishing enthusiasm around artificial intelligence technology and concerns about the U.S. economy's future, including potential impacts from President Trump's announced tariffs on imports from the EU, Canada, and Mexico, and of course China. The Nasdaq Composite on its side saw a more pronounced decrease of 4.25%, finishing at 17,303 points. High momentum AI stocks, notably Nvidia, weighted heavily on the index. Nvidia's shares tumbled 8.5% after its quarterly report failed to meet heightened investor expectations, leading to a broader sell-off in the tech sector, even though an upper correction is taking place as we speak. The Dow Jones Industrial Average demonstrated less resilience this week, posting a decline of 4.04%, closing at 40,813. This performance was at first bolstered by strength in defensive sectors such as consumer staples and utilities, as investors sought stability amid market turbulence before a new downturn.
So, the US markets have had a rough week, with tech stocks taking a hint, not to mention Nvidia's drop that shook up the Nasdaq. What about the EU markets though? How have they been reacting to these reactions?
In Europe, markets showed signs of stabilization despite lingering uncertainties. The Euro Stock 50 edged lower by 1.25%, with reflecting mixed economic data and ongoing geopolitical concerns. The German DAX initially climbed on positive election sentiment, but later retraced those gains amid cautious economic outlooks. However, compared to previous weeks and following heavy governmental investments in defense, European equities appear to be in a stronger position, with investor sentiment improving as recession fears ease and policymakers signal potential stimulus measures to support growth.
And what about the Asian markets?
There, the landscape remained similarly divided. The Hong Kong market stood out positively, buoyed by technology stocks and encouraging government interventions. However, most other markets in the region grappled with pressures from ongoing global supply chain disruptions and concerns over economic recovery prospects.
It was really interesting to hear about the recent stock movements, especially how markets across different regions are seeing various results. And obviously the shift in sentiment around IA and technology stocks is definitely something to watch out for. Speaking of market trends, how has Supermicro Computer Income, or the Supermicro for short, have been performing recently? What's driving its recent surge?
It has been in the spotlight due to sharp fluctuations in its stock price. As of March 11th, shares closed at almost $41, reflecting a 10.7% surge from the previous close. This jump positions Supermicro as one of the top performers in the S&P, standing out in a market where AI stocks have generally struggled. A key reason behind this resilience is the company's strong reliance on AI-driven revenue, which accounts for nearly 70% of its total sales. While investor sentiment toward AI has cooled, Supermicro continues to benefit from growing demand for high-performance computing solutions.
And beyond its stock movements, what other indicators have played a role in the Supermicro performance?
Well, it's Supermicro's financial stability that has reinforced investor confidence. The company successfully met a critical financial reporting deadline, avoiding potential delisting from Nasdaq, which reassured the market. Additionally, its recent partnership with Eviden to expand AI supercluster solutions across Europe, India, the Middle East, and South America is expected to enhance its global footprint in AI infrastructure. Financially, the company has demonstrated impressive growth, with net sales reaching $40.94 billion in fiscal year 24, more than doubling from $7.12 billion the previous year. Net income also saw a significant increase, climbing to $1.21 billion from $640 million in 23.
And Gasper, some of our audience is quite interested in technical analysis. So, do you have any thoughts to share?
Sure, when it comes to the technical side, Supermicro's stock remains volatile with key support levels at $38 and $26, while resistance stands at $48, $63, and $75. Investors are closely monitoring these thresholds for signs of future movement. Despite ongoing market uncertainties, Supermicro's strong financial performance, strategic partnerships, and AI-focused growth strategy have positioned it as a key player in the evolving tech landscape.
So now, let's hand things over to Tudor, who's got our market spotlight. He'll dive into the major financial trend and give us the week ahead, with all the key events and data to set up and shake up the markets. So Tudor, what's on the agenda today?
So, today we're exploring the nuclear energy sector and its transformative impact on global markets. Nuclear energy, recognized for its reliability and low carbon emissions, is significantly reshaping three critical areas: global energy transition, technological innovation, and investment opportunities.
Great. So, what are the current global trends and patterns in the energy transition then?
Well, nuclear energy is experiencing renewed interest as nations pursue climate goals and enhanced energy security. Nuclears currently provide around 9% of global electricity and accounts for roughly a quarter of world's low-carbon electricity generation, second only to hydropower. By 2023, global nuclear plants produced 2,602 terawatts an hour, a growth signaling renewed confidence, particularly in Asia. China and India lead this expansion, with over half of the new reactors through 2026 planned for these countries. Meanwhile, Western nations exhibit mixed trends, with Germany completing its nuclear phase-out, while others like France, the UK, and the US expand capacity or extend plant lifetimes driven by geopolitical tensions and net-zero emission commitments.
So, what are the latest developments in the nuclear reactors technologies, and so, for example, how they're transforming the industry?
Well, we have many, notably small modular reactors, which offer enhanced safety, cost reduction, and scalability. Over 80 SMR designs under development globally, and several prototypes are nearing operational status in China, Russia, and Argentina. Countries such as the US, Canada, and the UK are actively investing in SMRs and Gen 4 reactors, including molten salt and sodium-cooled fast reactors. These advancements aim to reduce reactor construction times, lower capital investments, and enhance safety and efficiency, potentially transforming nuclear economics significantly by the late 2020s.
Wow, that sounds quite interesting. But we've discussed the AI section with Gasper before, but how exactly is the AI and digitalization reshaping the nuclear energy and the sector?
So, actually, it is revolutionizing nuclear safety and efficiency. AI-driven predictive maintenance systems now analyze real-time reactor data to detect faults and optimize performance, dramatically enhancing safety and the operational reliability. Robotics combined with AI technology increasingly handle hazardous tasks, reducing human exposure to radiation. The International Atomic Energy Agency supports global research to integrate AI safely into nuclear operations, highlighting its transformative potential.
So, are there any notable innovation in the sector, and in particular, how do startups fit into this picture?
Well, nuclear fusion, once considered a distant dream, is now approaching viability after significant breakthroughs at the US National Ignition Facility, achieving net energy gain in 2022 and 2023. Startups like Commonwealth Fusion Systems, Helion Energy, and TAE Technologies, with backing from both private and government investments, over 7 billion in 2024, are working toward making commercial fusion a reality by 2030s. While practical deployment may still be decades away, fusion could potentially revolutionize global clean energy. At the same time, innovations in nuclear waste management are addressing long-standing concerns. So, Finland's Onkalo Deep Geological Repository, set to begin operations in the mid-2020s, will provide secure long-term waste disposal solutions. Additionally, advanced recycling techniques such as pyroprocessing and reprocessing methods are reducing radioactive waste volumes and improving fuel efficiency, which significantly alleviates waste management challenges.
So, and what is the investment outlook?
The nuclear industry remains dominated by state-owned giants such as Rosatom, EDF from France, China General Nuclear, and CNNS in China, and Korea Hydro Nuclear Power, alongside prominent private firms like Westinghouse Electric, GE Hitachi, and Rolls-Royce. Investment interest is particularly strong in uranium mining, reflected in recent spikes in uranium prices, reaching 65 to 70 per pound in 2023. Benefiting ETFs like Global X Uranium and Sprott Uranium miners, which experience substantial gains, companies involved in the reactor design constructions and operations such as Westinghouse and EDF are also positioned to gain from increasing nuclear adoption and supportive government policies.
All right, to wrap up our discussion on nuclear energy, could you maybe share with us some of the key risks and opportunities that are present in the sector?
Sure, nuclear investments entail significant risks, including regulatory uncertainties, high capital expenditures, and operational liabilities from potential accidents. However, these risks are increasingly mitigated by technological advancements, favorable policy shifts, and improved waste management solutions. The sector's growth prospects, especially driven by climate policies and energy security concerns, create opportunities for investors willing to navigate these complexities.
The discussion on nuclear energy was fascinating, especially as we move into an era where, as you said before, the sustainability is at the forefront on the people's mind. So now let's try to shift our focus on the week ahead, and let's try to bring conversation closer to the upcoming weekends. So Tudor, what are we to expect?
So first up, the Federal Reserve's policy meeting on March 18th and 19th. The Fed is widely expected to hold interest rates steady at 4.25% to 4.50%. With inflation cooling slightly, February CPI came into at 2.8%, down from January's 3%. Investors will closely watch the Fed's commentary for signals on potential rate cuts later this year. A dovish stand from the Fed could boost stocks and bonds, but may put some downward pressure on the dollar. However, any hawkish commitments, especially concerns over persistent inflation, could strengthen the dollar and lift yields, possibly hurting equity valuations.
So how are the other central banks responding to this current economic condition?
Well, on the 20th of March, the Bank of England made its interest rate decision. Expectations are that the Bank of England to hold steady at 4.5%, pausing after its recent February cut. With UK inflation hovering around 3%, policymakers will likely stay cautious. Investors will closely examine meeting minutes for hints of future cuts. A cautious stance could support the pound and slightly boost UK government bonds, whereas any hints at renewed inflation concerns could pressure stocks and raise yields. Moving to Switzerland, the Swiss National Bank meets on the 20th of March. With inflation extremely low at 0.3%, the CMB is expected to cut rates by 25 basis points, reducing the policy rate from 0.5% to 0.25%. This easing is largely priced in, aiming to avoid undershooting their inflation target. A cut could weaken the Swiss franc, benefiting Swiss exports and lifting European stocks, while bond yields may decline slightly. However, a surprise halt could strengthen the franc and create volatility in equities. The Bank of Japan wraps its meeting on March 19th. The BOJ is expected to maintain its policy rate at 0.5%. Despite inflation running at 4%, the BOJ governor, Ueda, suggests March is too soon for another hike. Investors will watch closely for any signals of potential tightening at their next meeting as wage pressures increase. Hawkish signals could strengthen the yen and slightly pressure stocks, while a dovish tone may weaken the yen, benefiting Japanese exporters and global equities.
And considering the upcoming earnings reports from, for example, the Global Flash, PMI, and FedEx, how do you think these indicators will shape our view on global economic trends and market sentiment?
Well, to begin with, FedEx, a critical indicator of global economic health, is projected to report strong earnings around 4.59 per share on revenues nearing 22 billion. This would mark nearly 19% earnings increase thanks largely to effective cost management and stable shipping volumes. Investors will closely monitor commentary on international package demand, especially in Asia and Europe. If their international package demand remains strong, particularly in Asia and Europe, it could signal economic resilience. However, if results come in weaker than expected, it could stoke concerns about a slowdown, especially for cyclical stocks. Meanwhile, the Global Flash PMI's release on March 21st will give us a clearer picture of the broader economic landscape. Expectations are mixed, with services potentially slowing and manufacturing showing slight improvements. Strong PMIs could boost global markets and lift bond yields, whereas weaker readings might revive recession concerns, benefiting safe haven assets like the dollar and government bonds. Diverging PMIs, especially strong European data against weaker US figures, could also lead to significant currency moves.
Alright, thank you Tito so much for your insights on this matter. It is evident that with the current economic releases, we should be very careful with our investments, especially in the future. So, we've explored global market trends, but now let's turn our attention to something closer to home, the Study Student Finance Society, and its effort to help students sharpen their finance and investment skills. With several exciting events taking place now, it's now that the perfect time to get involved. So first of all, on the March 13th, we held our Wealth Management Conference, offering participants a chance to delve into the world of wealth management. The event featured two engaging 50-minute roundtable discussion with experts in wealth management and banking, providing valuable insights to our members. Looking ahead, Shark Tank on April 26th will feature top student entrepreneurs from prestigious universities, pitching their startups to Spain's leading venture capital firms, with funding opportunities of up to 1.5 million euros. Join us for a unique opportunity to gain a valuable insight, discover breakdown innovation, and network with the future leaders of entrepreneurship. Don't miss your chance to witness the next big startup in action. So, let's wrap up this week. First of all, from tension between the US, Canada, and the EU to market growers, we have covered it all. We have looked at the geopolitical situation at the world theater. Secondly, this week, global markets have experienced significant volatility, with the US indices declining due to concerns over the AI technology and trade tariffs. European market, however, showed stabilization, while Asia's performance was mixed, with Hong Kong outperforming amid tech sector strength. Finally, nuclear energy is gaining renewed attention as nations focus on climate goals and energy security, with countries like China and India leading the expansion of nuclear reactors. As always, staying ahead of these shifts is a key to making informed decisions. Thank you for tuning in, and we'll catch you next week with even more insights and analysis.